When I was a kid, it seemed like everyone wanted to be an astronaut or a police officer or a firefighter, but I recently heard a teacher say that most of the kids in her elementary school class now want to be YouTubers. And just like the police officers and firefighters, those little future YouTubers are also eventually going to come face to face with taxes. And today I'm going to cover 7 mistakes I see YouTubers make all the time and show you how to avoid them so you keep more of your money. Hey, my name is Mark too, and I'm a CPA who specializes in helping resellers and content creators with taxes and with growing their businesses profitably. Over the years, I've personally worked with an increasing amount of YouTubers, not just resellers, but creators in everything from fashion design to rock climbing to lawn care. The amazing thing about YouTube is that it's not just about ad revenue, which is nice, but there's even more magic that comes when your channel becomes a platform for everything else you offer. Here's a few quick examples from some of my own clients. Kiana makes fashion design videos and makes a lot of her own cool stuff, and also sells her own sewing patterns to thousands of fans who love her content and her style. Ryan reviews rock climbing gear and runs an online store where he sells the top quality products that he stands behind. Jesse has a channel all about keeping your lawn lush and green, which is something I've personally struggled with over the years, and he now sells his own brand of premium grass seed. These creators aren't just entertaining, they're building serious brands, and that's not to mention the sponsorships, affiliate opportunities, and partnerships that are available to content creators like these. YouTube taxes aren't as straightforward as they might seem to someone just getting started. If you've started making money from YouTube through ad revenue, sponsorships, or affiliates, you're a business now, whether you like it or not. And that means taxes. So let's dive into the first mistake. Number 1, Google didn't send me a 1099 for my ad revenue, so I don't have to report it, right? Unfortunately, that is wrong. If you're earning income from YouTube ads, brand sponsorships, affiliate links, Patreon, coaching, or something else, you are responsible for reporting it on your tax return, whether you receive a 1099 or not. 1099s are really just a courtesy. The IRS doesn't care if someone forgot to send you one. If you receive the money, it's still income. Here's the bigger issue. A lot of creators get paid through PayPal, Stripe, Venmo, Zelle, and not all of those platforms will always issue 1099s unless you meet certain thresholds or have a business account. But the IRS is moving toward a more aggressive enforcement policy, especially with 1099K reporting changes. So if you made $3,000 from affiliate links and nobody sent you a tax form, that doesn't mean that it's tax-free. You still need to report that income on your taxes. And this is where bookkeeping matters. It's not ideal to only rely on your bank statements to figure this all out at tax time. You should know what you earned and what your deductible expenses are. Okay, tax mistake number 2. Filming it doesn't make it a deduction. I filmed my car in a YouTube video, so I can just deduct it, right? That's an actual question I've received. If only it were that easy. And maybe most of us already suspect that it's not that easy, but what about clothing and makeup? Just because you wear it in a video doesn't necessarily mean that it's deductible. There's a big difference between using something in your content and that thing being ordinary and necessary for your business. Here are a few tips. If you wear regular clothing in a video, the IRS does not consider those clothes to be part of a costume. It's just what you wore that day. It's not deductible. But if you buy a pirate costume for a sketch, that's most likely deductible because it's more of a prop and more directly tied to your video. As far as makeup, if it's used exclusively for filming, the IRS might give it to you. But if it's your everyday foundation that happens to look good on camera, probably not. The IRS doesn't want you writing off your entire life as a business expense. So if you want to deduct something, ask yourself, would I have purchased this if I weren't making this content? Am I also getting a personal benefit of any kind? If you got your nails done for the video, for instance, but also now benefit from how great they make you look in your personal life, it's not deductible. Mistake number 3 is not understanding the rules around gifts, giveaways, and collaborations. A lot of creators love to give back to their audience. Giveaways can be great for engagement, but that doesn't mean that they're great for your taxes. So here's where people mess up. You can deduct the cost of a giveaway, but not the retail value. And it has to be for business, not just out of the goodness of your heart. So if you buy a $200 microphone and give it to a subscriber in a giveaway, you can deduct the $200 as a promotional expense. But if you buy a $200 purse for your friend and say, oh, it's technically content because I filmed it, that's not going to hold up. Also, if a brand sends you products to give away, you may not be able to deduct anything because you didn't pay for them. For collaborations, if you're sending products, paying guest creators, or doing promo trades, track those expenses properly and treat them like any other business cost. Mistake number 4 is missing out on or incorrectly reporting the QBI deduction. QBI stands for Qualified Business Income, and this is a deduction that's only a few years old that most creators have no idea that they qualify for. If you're self-employed and your business is structured as a sole proprietorship, LLC, or even an S Corp, you can likely deduct 20% of your net profit from your taxable income. Say you made $100,000 in profit. You can likely deduct $20,000 before before calculating your tax. And I say might because the amount of income that you generate and the type of income will determine if you qualify for this deduction. I actually think it deserves its own separate video because this is something that even a lot of CPAs miss. So stay tuned. But for most content creators under the thresholds, it's easy free money, and it's shocking how often it gets missed or misstated. Even if you're using TurboTax and you don't understand the nuances, it might not prompt you correctly. But the bottom line is, if you're making money from YouTube and it's legitimate self-employment income, make sure you're aware of the QBI deduction. Mistake number 5 is claiming purchases incorrectly. Camera gear, computers, lighting setup, these are often the biggest expenses for creators. But here's the catch, you can't always write off the full amount at once. So how it works is the IRS rules say that you're supposed to depreciate big purchases over time, usually 5 years. This means that if you purchase a $4,000 camera, you can't deduct the whole thing in the year, but rather you're supposed to deduct it in chunks over 5 years. But before you do that, if your item costs $2,500 or less, you can usually use what's called the de minimis safe harbor election. That means that you can expense it or deduct it right away without even having to worry about depreciation, as long as you're consistent and make the election on your tax return. So a $2,400 camera lens, expense it. A $200 microphone, just expense it. A $50 tripod, definitely expense that. Just make sure you keep your receipts and track what you're using for business. If it's 100% for YouTube, it's 100% deductible. If it's only 50% for business, you can only deduct or depreciate that 50% portion. Mistake number 6 is skipping the home office deduction. If you're filming content at home, like most creators, you're probably eligible for the home office deduction. This is one of the most underused deductions out there. You have two options. You can use the simplified method, where you can deduct $5 per square foot up to 300 square feet. So it's a max of a $1,500 deduction. Or you can use the actual expense method, where you calculate what percent of your home is used for business and then deduct that percent of your rent or mortgage interest, your utilities, insurance, and other shared home expenses. To qualify, the space has to be used regularly and exclusively for business. That means if you're filming in your bedroom, but it's also where you sleep, that's not going to count. But if you carve out a corner of the room or an entire separate room and dedicate that space to your filming setup, that will qualify. I have clients who use an entire basement or floor of their home for their business, and that enables them to essentially deduct 50% of their rent, utilities, and other shared expenses through the business. And that's significant. If you've got a legitimate filming space, desk setup, editing station, don't skip this. It's low-hanging fruit. Mistake number 7, trying to write off every vacation as a content trip. Just because you made a video on your vacation or Instagram story, it doesn't automatically make the trip a deductible business expense. Here's the key question to ask yourself. Am I going on a trip to film a business video, or am I filming a business video to justify going on a trip? Just think about that for a second. If the primary reason for the trip is business, you're attending a YouTuber conference, you're filming content for a paid brand deal, you're meeting with sponsors, then your travel to and from the destination is fully deductible. Let's say you go to New York for a 2-day creator event, but you stay 5 days total. You can deduct 100% of your flight because the main reason for the trip was business. You can also deduct the hotel and meals, but only for the business days. The personal days you're on your own for. But if the main purpose of the trip was personal, like a family vacation, and you just happen to film a YouTube video while there, then none of the overall travel is deductible. Last year, I took a trip to the Philippines with my wife and 2 of my kids, and ended up deducting most of it because the primary purpose was to go out and meet with my team. And I'll link that below so you can go see how I deducted my kids as well. The key takeaway is, if you wouldn't have taken the trip without the business reason, you can likely write off the travel. As always, keep your records, the dates, your receipts, the itinerary, who you met with, and what the business purpose was. The IRS doesn't care how good your TikTok was if your receipts don't back it up. So yes, being a content creator can be fun, but once you start making money, the IRS sees you as a business. The good news is that you've got a ton of legitimate deductions available to you. You just need to know how to use them the right way. If you want help staying out of trouble and keeping more of what you earn, consider joining my Financial Insiders membership, where I answer your posted questions with video responses, or in our live coaching calls, we review your tax returns and have a supportive community of small business owners who want to get their financial ducks in a row and take their businesses to the next level. If you know a YouTuber or content creator who could use some help, send them this video, and use the links below for more resources to help you optimize your tax situation and overcome the anxiety so you can focus on building your business profitably.